Know who I am. I'll start. So I'm Benjamin Horowitz. I'm the president of the FEI Long Island chapter. I want to thank everybody for coming to today's meeting. We are honored to have one of our longstanding sponsors, Nixon Peabody, and a really fantastic gentleman by the name of Alan Cohen, who is going to take us through a really, hopefully, awesome hour here. Interactive, please feel free to jump in along the way. And with that being said, I am going to kick it on over to Alan.
Thank you, Benji. Actually, Benji and I were sort of commiserating over the life of a service provider in 2021, where there are no temporal or other boundaries around when and how often your clients can reach you, and they're taking full advantage of that. Maybe one day, the likes of Benji and I'll be able to say no to somebody, but right now we haven't learned that trick.
Yeah.
Not like the dog knows enough if it's 95 degrees out to turn around and go back inside. You can teach the old dog, but you can't teach Benji and I. And the vast majority of what's keeping me more than busy is clearly mergers and acquisitions work. The elevator ride, for those who don't know Nixon Peabody, it's an AmLaw 100 law firm. It's the only international law firm with an office on Long Island. We have offices in Asia, across the United States. It's a big firm with a lot of capabilities. I'm a business lawyer and manager of the Long Island office. Most of my work is indeed in mergers and acquisitions, and I've gotten quite the education, if I hadn't gotten it during my first 32 years of practice and my 33rd on M&A and what sort of makes people tick, because it's really just an unusual time. I mean, just to give you some context, although I don't want to overly personalize it. If I'm doing 4 or 5 deals, active deals at a time, that's a full plate. Right now I have 15, and with a pipeline. So combine that with the fight for talent and all the other complexities, again, of being a service provider in this day and age, and it's quite challenging. But we always find a way to figure out a way to get the work done. I do intend for this program to be interactive. I haven't had problems with that in the past when I presented to FEI. So you should feel free to speak up, ask questions, or if you feel more comfortable, throw something into the chat box to me, and I'll do my best to respond to it. You don't want to just hear me talk for an hour. You're gonna get tired of listening to me. And throughout the course of the presentation, as there'll be some polling questions. So just let me start with some sort of statistical backdrop here. I won't bore you with too many statistics, but it gives you a sense as to what we're dealing with here. Quarter to quarter, the first quarter of 2020 to 2021, the number of deals closed, M&A deals, was up 94%. It almost doubled. Now, I suppose a portion of the first quarter of 2020 was COVID impacted, but I will tell you that most deals that were in the works middle of March, which is when we closed our doors, saw themselves to completion. We didn't, there was a lot of hesitancy about continuing on with deals, but once there was some momentum built towards getting a deal done, they did, get done. So I don't think that number is overly impacted. The last 3 months, March, April, and May, we've had 3 consecutive increasing record months of M&A deals in terms of dollar value. And from January to May of 2021, $2.4 trillion worth of deals globally, either completed or pending. Those are just astronomical numbers. They're due to a lot of factors, and that's going to be the subject of the presentation today. And of course, I would like to get your views too. But why don't we throw the first polling question up here, and it kind of brings us up a bit and get the ball started that way. Okay, we have 6 out of 7 with something by phone, so that might be 100% of who we can expect. Oh no, got all 7. So 1 out of the 7 said that your buyer to the close a deal before the end of 21. One of you is a seller, expected to close a deal in the same time frame, and a bunch of you aren't engaged in M&A transactions. Although I suspect that if you aren't, you wish you were, because I love what I do and you probably like it too. So to make over in very broad strokes, kind of an outline of the reasons why I think, and there are a lot of them, that M&A activity is up dramatically this year. The first and foremost, and one that gets talked about the most, is the fear of increased tax rates, right? Concern that long-term capital gains rates will equal ordinary income rates under the Biden tax plan. The second, would be lesser known, but as impactful in my world, is the fear of interest rates going up. Because of course the interest rates going up increases the cost of borrowing, and a lot of these buyers borrow to make their acquisitions. The third thing is SPACs, and shout out to Ken Rasika, who noted that he's involved with SPACs. We'll get to that in a little bit more detail, but clearly a bit of a game changer. Is it going to be long lived? I don't know, but for now it's making a big impact. The next thing is, although we talk about COVID and the impact of COVID on the economy and everything else, there are some sectors that are actually doing quite well, and those are especially ripe for sale. The next one, and you hear this all the time. It's a constant reason why there shouldn't be more work, and that's why M&A lawyers always say it every single presentation, is the PE funds have had a lot of success raising money the last 2-3 years. They have that money. They need to deploy it. They need to do the deals. There's a lot of money chasing deals, and that's certainly going to help fuel things. But also the strategic buyers, a lot of them have done quite well in the last 12 months. Not everybody got harmed by COVID. Some companies did exceedingly well, and have a whole bunch of money in the bank and have access to borrowing at low interest rates. So not just the PE funds, but also the strategic buyers have a lot of cash. The next thing is I call it with Biden taketh away, he also giveth. There has been some legislation passed that is economically stimulating, as we probably all know. There are other plans being worked on, and all of them do have the impact of stimulating an economy, which kind of feeds into my last thing, which is a bit of a contradiction, I suppose. It's not the last thing; there are two things. But we've been in the longest economic expansion in history up until the time that COVID hit. And I will tell you that in the first quarter of 2021, all of us transactional lawyers were waiting for the shoe to drop, right? Because you just can't legislate around economic downturns; they just happen. But that concern still exists. Whether COVID, if you take the impact of COVID out of the equation, whether the economy was in fact ready for some sort of pullback. I don't think people have forgotten that and still are concerned that could happen. The last thing, I should try to coin a phrase, maybe like trade market. I know service market, but I can't quite come up with the right phrase for it. But I don't know if it's COVID fatigue or it's fear of a COVID repeat. But there are a lot of business owners out there, and I'm thinking now in terms of Long Island. A lot of you are Long Islanders, and small, closely held, family-owned businesses are not so small, right? Some 9-figure businesses that are closely held or family-owned, and there's a genuine concern or consideration being given to not having to go through this again. It was just a horrible 2020 for a lot of people, and I think there's a fear there could be another pandemic, and that they might have to go through this again. And if you were close to selling, you were on the border, you thought maybe you had another 5 years, maybe not, maybe 3 to 5, maybe now's the time. sell and not have to take that risk again. So I'm hearing that from plenty of my clients. So before I circle back around and go over these in some detail, why don't we throw up another polling question? Great. So again, others perhaps not sort of actively involved in the M&A, but a couple of you are being creative in your pricing structures. I want to talk about that for a couple minutes, and others are just limiting diligence to get to closing quickly, which makes a lot of sense if you're in a competitive environment for a company. Speed is not your friend. Speed is your friend. Delay is not. So, a lot of what's happening here, the concern that was expressed as we were coming out of COVID was, would buyers be interested in businesses that were COVID impacted, right? Earnings were down. And, you look at the financial results for 2020 for a lot of potential targets, earnings were, EBITDA was down. Was it going to go back up? Perhaps. They're having COVID premiums paid in respect to past earnings. But what a lot of buyers have done, whether it be PE or strategic buyers, is say, look, let's price you based upon 2020 or maybe some premium to 2020, but we'll pay you an earnout based upon your success in 2021. Earnouts are difficult to craft, but if the tension is between not doing a deal or doing a deal with an earnout because 2020 results don't accurately reflect the quality of the business, you may go with a creative pricing structure that includes an earnout to kind of bridge the gap. So let's go back and explore sort of a little bit more detail these factors that are fueling this M&A spurt. I mentioned the first one was the fear of increased taxes, right? So in the Green Book, Biden expressed his desire that capital gains rates under certain circumstances be equal to ordinary income rates. And there were some limitations around that, but it really was potentially chilling to the M&A market because you're looking for increases, from 20 to perhaps almost 40% in the taxes that would be applied to your capital gains upon the sale of your business. And this has been a lot of discussion. There's been a lot of discussion among lawyers, accountants. In this regard, accountants have been our friends because they've been creating a frenzy out there. I think maybe lawyers tend to be a bit more a bit more liberal and accountants more conservative, sort of in their politics. So overgeneralization, but I have heard a lot of accountants really putting the fear into their clients. They have to close the deal quickly because Biden will inevitably increase tax rates. The plan would be to increase them to 37 to 40% on adjusted gross income in excess of $1 million. So, for example, if a seller was taking a note and the note was paying millions of dollars per year, you could expect cash flow that exceeded that AGI threshold and a tax on the excess of a substantially higher rate. What was particularly chilling here was the fear this was going to be retroactive. And again, what Biden said he wanted to do was make it retroactive to the announcement of the plan. Now, the announcement of the plan was April 28th, 2021. So you have people still working on deals. So I guess they've discounted the likelihood that that's going to be an issue, the retroactivity, that is, even though it could be that they sell a company now And Biden, if Biden were to get his way, the increased capital gains rates would sweep up their deal because they'd be retroactive to April of earlier this year. Now, a lot of the pressure has been taken off of that concern. Biden has been unable to get any sort of controversial or even maybe non-controversial legislation through to this point. And certainly it would be a heavy lift to get capital gains rates up, or at least up significantly, and up significantly enough to make you want to rush to do a deal. So I don't think that business owners are that concerned, but nobody can tell them for sure. And I literally have a deal closing today because the seller is insistent on closing the deal before the end of the second quarter, because he thinks that maybe Biden won't get his way back to April 28th, but he will through the second quarter. So why do a deal July 1st? So he's declined. So of course he's right. I might describe him as hysterical because it's hard to imagine that that's going to be the line of demarcation. But you really don't know. So as uncertainty can either put a stake in M&A activity or it could fuel it. In this case, it's fueling it. And as long as this is up in the air, including through the 2022 elections, which could impact Biden's ability to pass the legislation he wants, there are going to be people that are going to be keeping an eye on this and making their decisions whether or not to sell their businesses based on this fear of increased capital gains rates. So I'm going to stop there. Does anybody have any questions? Want to make a comment on what they're seeing or their opinions on not on the heat. You talk about that too, but on please, Vincent.
Yeah, no, Alan, how are you? I just put a question in the chat room, but basically the question was going to be around, have you seen people during this time period, and particularly sellers, try to get clauses into their agreements that address the retroactive change in terms of a price adjustment on the outside chance that legislation, it's very unusual. I've never seen it before, but have you seen people try to negotiate that in order to keep deals moving?
I haven't even heard it mentioned. Maybe it was mentioned outside my earshot, but none of my sellers are talking about that. And I will tell you something. Private equity buyers especially cut things pretty thin, or at least that's what they'll try to convince you. Like they're paying you as much as they can possibly pay you, because they have their responsibilities to their investors, and the bank will only lend them so much money, and God forbid they should put in additional capital to make up for the difference, right? So they're for them to include the potential impact of increased tax rates resulting in increased purchase price in their pricing model they'd be like going through their old MBA books, like figuring out how to deal with that. They would just have no idea. Yeah. So I don't think that's. I think it's probably why it hasn't been raised. I just don't think that's likely possibility. Creative though, and by the way, you could see people like doing things like trying to split the difference, on these things. And interesting too, that that conversation does come up in a couple of contexts. One is where there's an allocation of purchase price to assets that attract tax at ordinary income rates. In that context, it's not unusual at all for the seller to try and negotiate, hopefully in the letter of intent, or the horse may have left the barn afterwards, but negotiate for some sort of make whole to the extent that there's an allocation of purchase price. But there, you're talking about the buyer getting a deduction. So there's arguably some deduction, some benefit that the buyer might not have been bargaining for that it gets, and to pass that along or to split it with the seller has some intellectual appeal. The other thing is where similar, you have deals where there are clawbacks. For example, a deal is done with a seller. This happens a lot in healthcare, where you're basically buying the goodwill of the practice, right? But it's other contexts too. And the buyer says, look, if you leave within the first 5 years, you're going to forfeit a portion of rollover equity, right? Which is a different topic. And, I always complain because I say, well, you're tying purchase price to continued employment, and doesn't that risk getting taxed at ordinary income rates? And now shouldn't you make us whole? Mostly I don't like the clawback. I like them to get rid of that. But, sometimes you win that, sometimes you lose. But there again, if you say that the buyer or the seller will take consistent positions on their tax returns, if this is purchase price for the business and not compensation, and if you can, you're probably okay if you can negotiate a make whole if the buyer somehow gets some deduction because what was purchase price is really deductible compensation. Then again, intellectual appeal. Indemnifying somebody because they're paying increased taxes when the buyer gets no benefit, not going to happen.
Yeah, Alan, I agree. It's an unusual provision, and I had seen it a bunch of years back in 2012 when the rates changed, and I was with a company where we had bought a few businesses right up at the end of the year, and we were sort of a motivated buyer, so we kind of went a little over the edge of where you might normally see a buyer, but we actually did indemnify the sellers for the tax treatment that they were going to get on selling in light of the change in the capital gain rules that took place in 2012. But I agree, it's probably an unusual, we bent over backwards to make deals, so it was sort of an unusual situation.
Right. Thank you, Rob. Okay, moving on to moving back on to my second sort of thing that I see as sort of the top of the list of fueling the M&A activity is the concern that interest rates are going to go up. So we've had record low interest rates for like a protracted period now. And as I mentioned before, certainly PE buyers, but a lot of other buyers who don't have cash, available to them, not cash in the bank. I mean, they borrow. In fact, PE firms' model is to borrow to fund acquisitions. So, there has to be some concern that, especially against the background of whispers of inflation, I blame Julie and her lumber for that. That interest rates are going to go up. It's going to increase the cost of borrowing. And again, it's just PE firms model this out in their overly arithmetic approach to valuation. You can tell how I feel about this, right? That it's going to spit out of their computer just lower purchase prices. So I think it's something that is a second tier concern, but I think is drawing some interest. Now, inflation, I think, has been revised to go up from 2.4 to 3.4% this year. But I think at the same time, there's some belief that is just temporary. And just like the lumber prices are going to come down so I can redo my deck, other prices are going to come down, and the concern about lower interest rates is going to wane. The Fed has announced that they don't think that they're going to be increasing interest rates until March of 2024, right? So I mean, music to an M&A lawyer's ears, right? It's like I'm gonna be busy now through through March 2024. My family's not so happy, but it is what it is. The next thing I want to touch upon is SPACs. So I don't know if people are familiar with like reverse mergers into public shells. Those were kind of popular back at the dot-com days, and even since then, and seen as a second or third or fourth tier way of a company getting public. And what would happen is that somebody would acquire a shell, a public company that had raised money, and despite having raised money, had gone out of business and was sitting with cash in the bank. Registered as a public company, although not perhaps registered to raise money as a public company. And what these SPACs are doing is they are acquiring these shells. They're sort of quasi-public companies. Again, they need to register to raise additional money publicly, but they are registered as public companies. And then they're buying and raising money. And it's a shortcut way to go public. And I don't know, I have my doubts whether or not the SPACs are going to continue to be as popular and generate as much interest and resultant deal activity as they have. Lately, they've come under a fair amount of scrutiny because when you play it close to the line in terms of regulatory compliance, you're bound to find some regulator think you went over that line. And I think those are the whispers right now. But in the meantime, there's some prominent SPACs out there, including a couple that are being formed on Long Island that are making acquisitions. I saw a number that almost $350 million of acquisitions so far, $30 billion of acquisitions thus far in 2021 by SPACs. And if you remember the number I gave below, I gave earlier, that's a 20%. That's a big percentage of the M&A activity in the first quarter. Ken, I know you're active in the SPAC space, and I don't know if you've gotten up to get some breakfast, but if you're on, do you have any thoughts or comments? Okay, he might have walked away. Good lawyers only ask questions they know the answers to. So draw a conclusion from that. So the next thing is, there are certain sectors of the economy that are doing immensely well, right? And attracting huge multiples on their EBITDA in the M&A space. And again, is this going to continue? Not forever. So if you're thinking it might be time to sell, this is a good time. My food and beverage clients are doing extremely well. Obviously, I talk about restaurants, but manufacturers and distributors of food are just kicking it. That their profits are way up, and increased EBITDA in and of itself generates increased multiples of EBITDA for the buyers. So let me explain. A slow, sleepy company that generates $1 million or $2 million of EBITDA, might attract a certain multiple in terms of its valuation in a deal. If you can increase your EBITDA, the multiple is likely to go up. I'll explain why. And so there's sort of an exponential quality to growth. So if there is growth, companies that might have said, gee, I might have sold at a 6x multiple in 2020, are finding that not only are they making more money, but now they can sell it at 10x multiple. So it's very attractive. And the reason why, just think about the math and the logistics of it. Acquirer who wants to acquire, profitable growth, EBITDA, and they could buy 8, $1 million companies or one $8 million company. And whoever's been in the M&A process before recognizes it's a lot of work. Integration's an issue and carries with it some risk. So larger companies simply are significantly more attractive. That's also kind of helping out here. Not a lot to say about the fact that PE firms have a lot of money. They always have a lot of money. I hear they've been successful at obtaining additional investment. They always say that, even in down times, as that's a reason why the economy should come back. as opposed to continue to get bigger. But that's certainly the case. And as I mentioned also, the profitable companies that are acquisitive, again, have opportunities here to grow bigger. Before I segue into my next point, perhaps we could throw up another one of the poll questions and get your results and chat about that. A bit of a split of opinion here, although most folks can't tell whether the change will be permanent. So, I mean, look, the process certainly has changed. Things are more streamlined. People don't get in the planes. They don't visit. I think people have gotten more comfortable with Zoom and expedited processes to get deals done. I think that my opinion is it's changed permanently. The question is how much pullback there will be from what we have now. So, it does remain to be seen, but to think that we'll go back to the way things were entirely. I mean, we were already changing. I like to say in many ways, COVID accelerated the direction in which M&A, even just the way we work, was already going. So that certainly applies to work from home. Anyway, I think we're already going to continue to move in a certain direction. Hard to imagine it's going to go back entirely to the way it was because it wasn't staying there. My 2 cents. So something that I'm hearing a lot from my clients that are sellers or not sellers, but they're considering selling, is something that I mentioned. I think this is important, right? I tell people all the time that most of what I do for a living is psychology and not the practice of law. And that's probably the same with a lot of people we're on this call today. So people, business owners will come to me and they'll sort of vent, right? They'll kind of lay out their feelings, tell me about their feelings. And I'm expensive as a psychologist, but I do it. And there is really intense fear that they're going to have to go through 2020 again. They don't think it's going to happen in 2021. I don't even think they're sure it's going to happen in 2022. But they figure inevitably there's going to be something that's going to result in a shutdown akin to what we suffered in 2020. And they frankly want no part of it. It was very tiring, very draining, very risky. And if you're on the cusp of selling your business, or you can sell your business, maybe it's not the right time, but you could sell it and economically make it work for you, then there are a lot of folks that are thinking that they just want to sell. I will tell you, just again, sort of personalizing my profession, we've had a flight out of the legal profession to in-house positions or other lines of work, because people just don't want to do this again, or they don't want to do this anymore. So I'm not sure they're going to find the answers in their next stop, but I do think that this was sort of an impetus for change. And in the case of business owners who might have been thinking about making a change, I think this is sort of fueling the change. I'd be curious to know whether or not anybody has any thoughts on that, or hearing the same thing. People want to speak up. Let me know what they're seeing and what they think. Nope, quiet group. That's okay. The last couple of things that I want to talk about were just sort of the economy, where it's headed and where it's at. And by all signs, the issues that the economy is having are impacting only very limited sectors, very limited geographies, and not necessarily companies that are impacted from an M&A point of view, by that limited downturn. So again, if you're in the restaurant industry, maybe not so much on Long Island these days, or at least not places that survive, or the places that we have our power lunches. They all seem to be doing okay. But a lot are not doing well. Hospitality is still suffering. But if you're not doing M&A in the hospitality arena, and you're working with manufacturers and service providers, companies involved in e-commerce or e-sales, you're doing dramatically well. And this continues to be a period of economic expansion. And that fuels both sides of the M&A equation, right? Buyers with more money to make acquisitions, sellers doing well, and being able to show the types of the numbers that are required to engage in a profitable sale of the business. Again, pretty kind of what I'm seeing here. Steph, want to throw up another poll question? Okay, looks like we have unanimity on this one. Yeah, I think this is the general consensus, right? Is that the risk of Biden getting these rates up to ordinary income rates is like landing a man on the moon, no, maybe less. Yeah, there is going to be pressure to increase rates to pay for various plans and programs. And I do think there is a sufficient amount of sympathy for that in the moderate Republican side, that a modest increase is likely. Now, I mean, business owners spread over that, but even with the ordinary income scenario, I don't think that business owners, entrepreneurs selling their businesses was ever the true target of these increased capital gains rates. So you never know how the legislation is going to come down, nor can you assume that it's going to be logical, because people they make trades, and some compromises that don't hold together eventually make their way through. Yeah, I agree with everybody who agrees with each other apparently that capital gains rates are likely to go up to fuel to pay for some of the deficit here, but certainly not up to ordinary income rates. There are a couple more questions, so why don't you throw the next polling question up? We can talk about that. Right, so this is consistent with what we're talking about before, although it might have been a bit of a trick question as I read it again, because it definitely does create urgency to get deals done. There's no question about that. I don't, as I read the question again, I'm not sure it's going to impact valuations too much, because as I mentioned in response to Vincent's question, I'm not sure that buyers are going to factor that in calculating their valuations. But I do think that ultimately the answer probably is yes in terms of the urgency to get deals done, not for valuation reasons, but more because the seller's thinking about the net to them of doing a deal right now versus doing a deal in the future, maybe I'm thinking in 22 or 23, when maybe there is a possibility of these rates going up. And Stefan with the last poll question. Okay, pretty evenly spread out, right? Which probably means that we're seeing it in a lot of places, right? It doesn't mean that one's right and one's wrong. And I think that the answer suggests that it's actually quite widespread. If I put hospitality in there, it probably would have gotten none. I put in things that all are seemingly attractive to me. One that didn't get a vote was had food in it or consumer. Maybe it depends what that consumer business is, but that too is getting a fair amount of attention. I'm curious whether anybody's got any specific sort of anecdotes about things they're seeing in specific industries in terms of M&A or other activity. I mean, certainly you're welcome to share that with the group. Oh. Any folks have any questions? Comments, concerns?
Alan, I have a question. So we talked earlier about people going to earnouts, right? My experience with earnouts were horrible, because I was the buyer and I felt that any change I made to the company we acquired caused problems, and especially if they didn't make their earnout, there was always the claim that we changed the business, right? Do you see earnouts more not working or more working?
So I think earnouts are a path of last resort. It's only when they're necessary for a motivated seller and motivated buyer to bridge a gap they cannot otherwise bridge. And it's interesting, in my profession, there's a lot of reliance on custom and practice, right? It's not that cookie cutter, but we kind of know where the market is on various terms. If you tell me how big an escrow want to be, I can tell you that, or how big a deductible or a threshold or a cap. I can tell you what a working capital adjustment looks like. Very narrow ranges, but relatively narrow, right? The deals get done within, between the 40-yard lines. When it comes to earnouts, they're all over the place. There really is no market. It's all about the negotiating power of the respective parties. Because there's this inherent conflict of interest. The buyer has just paid something. They haven't paid nothing. They probably paid a majority of the purchase price and feel entitled to run the business as they see fit. The seller is saying, well, this earnout was a key component to the sale. I'm counting on getting the money, and I want control. Perhaps the seller remains employed after the closing, which at least they have some oversight, but you can't guarantee employment. Just like the employee could always quit. An employee can always be fired. Maybe it's pay a toll, severance, but you really can't effectively make up an earnout if there's a firing of an employee, because then you're asking for it to be characterized as compensation and not purchase price. I think that's pretty well accepted within the M&A community. So the range of possible outcomes is wide. And the drafting of those outcomes is inherently subjective. So, Drew, it gets down to what you're talking about, which earnouts are an area of merger and acquisition activity and the purchase agreement that are just ripe for litigation, just at least disputes and possible litigation. And
Right.
I've been brought into a number of deals that I didn't do because although I'm a corporate attorney and I'm in the business of litigation prevention, I have read a fair number of contracts. And I often get brought in by other law firms that might be conflicted out because they might be witnesses for me to read provisions of deal documents. And I would tell you that 4 out of 5 times, I'm asked to read provisions on earnouts and render an opinion as to whether or not, their client has the upper hand. And it's always, you can never do more than more likely than not, because it's never certain. So I wish I could rid the world of earnouts. It would make malpractice insurers very happy, but you can't because it is a tool. I will tell buyers though, to do a fair amount of buy side work, is that the best earnouts are the ones that are merely safety nets that the seller really should get it. And they protect you only from Armageddon, but they're not so aspirational that it's going to create friction when you exercise authority with regard to the company, or you demotivate the seller that stays on because the seller's thinking, I'm not getting this earnout, so why am I staying here? Anyway, that's my thinking on those.
Thanks.
You're welcome. Anybody else? Questions, thoughts? Okay. Oh, Vincent, you're on mute.
Yep, there we go. I assume most of your deals, maybe it's a bad assumption, most of your deals are private deals as opposed to public?
Yes, vast majority. I represent a number of public company acquirers, but they are acquisitions of private companies. And my sellers tend to be all private. It wasn't always that way, but my practice is very much a practice that reflects Long Island. And as we know, there has been a flight of public companies from Long Island. Now, a couple of the ones that are still here, I still do buy-side work for, but again, it's not public deals, which are have their own uniqueness to it, especially with regard to indemnities. Most of the sell side are all private companies.
Yeah. And any particular governance issues on the public company side that stand out? I mean, invariably, it used to be that if you're a public company board member and there was a sale of the company, for good, better, and different. I mean, from your perspective, public company governance issues that stand out in the deals that you've seen.
From the sell side.
Yes. Well, either, I guess. But,
yeah. Well, the sell side is hard, right? You sell a company, you're a board member, you're approving it. You just wait for the lawsuit to come, right? From somebody who says you didn't get fair value.
Right.
So that could be very disconcerting. It's almost like a cost of doing the deal, which is unfortunate. So there's always risk. It's a thankless job, right? If you do if you sell for a good price, everybody expects it. If you sell for something less than a good price, then you get nothing but criticism. It's tough, and that's what also makes it difficult for people to want to accept jobs as on public company boards. There's a lot of liability associated with it. From the buy side, less of a concern. I don't know if I've ever seen a member of board directors of a buyer get sued because they made a bad deal. On occasion, you've seen some real dogs, high-profile dogs, but it's usually on the sell side, because it's a cottage industry of lawyers that look at these public company deals and make money negotiating settlements that include a contingency fee for themselves for challenging whether or not the seller board exercises fiduciary duty in agreeing to sell the company.
Thank you.
You're very welcome. Okay. Well, with that, Benji, I'm not sure. Oh, there you are. You're still on.
Yeah.
Anything to wrap it up?
Yeah, no, awesome. I appreciate your time. Appreciate the presentation. So just to share with everyone that's on here, we have a next event in July regarding cyber threats, and then we have another event. Or it's July 14th. Sorry, July 14th, hosted by BDO. So if everyone can go to the FEI site and just register for it, we'd love to have you. Again, thank you everybody for being on here. Thank you to some new folks who are on here, new faces, my fellow board members, and special thank you to you, Alan. Again, we appreciate you coming on and doing this.
My pleasure. Anytime. Thank you all for listening to me.
All right. Thanks, everybody.
Okay. Be well.
All right. Bye-bye.